top 3% of VCs are really making money. So they have more than 5x over 10 years, and therefore outperforming the index, but below. So 97% of VCs are not performing at all better than if you could or buy a chunk of shares on the index.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Marc Wesselink with us. Marc is a co founder and general partner at Venturerock. Venturerock is a venture building and venture investment platform where they aim to advance technology, science, and innovation to co create and grow the next generation of global tech companies. In this episode, we talk about the flaws in venture capital, how they are fixing the flaws by following a unique investment model at Venturerock, the 72-step venture building OS they follow at Venturerock to build successful companies, having offices in 4 different continents with dedicated focus for each region, and so much more. So without wasting any time, let's dive straight in. Hey Marc, so good to have you on the VC 10X podcast. How are you doing?
Good to be here. Thanks.
Awesome. Pleasure having you here. And I'm very excited to talk about how you're doing things differently in venture capital. But to start things off, can we have your background story and how you started investing?
So I'm a founder since 1994. Between 1994 and 2008, I've started 12 companies myself. Failed 4 times, sold 3 companies. 1 company got listed on a London Stock Exchange, but also got experienced 2 bankruptcies after the 2008 crisis. So I've got a little bit all the ups and downs of a founder journey. Since 2008, actively investing in early stage companies. That led to an accelerator program called Startup Bootcamp, where we've rolled out an accelerator program worldwide. And since 2018, I'm trying to change the venture capital model from a bullshit-based investment to a evidence-based investment with Venturerock.
Yeah, absolutely. That's very interesting. And I believe that it was while your time at Startup Bootcamp when you noticed these flaws in the venture capital space. Can you talk about what were these flaws exactly? And then after that, we'll talk about how you're trying to fix it.
These flaws were threefold. Number one, VCs spend on average 99% on their time finding the best deals, reading through 2,000, 3,000 pitch decks a year, receiving tons of requests from all parties involved to invest in them. Based on that, they do 3 or 4 investments a year. On the other side, founders that are spending over 70% of their time in the first 3 years on fundraising. The CEO often is dedicated to fundraising process. And thirdly, that the top 3% of VCs are really making money. So they have more than 5x over 10 years, and therefore outperforming the index, but below. So 97% of VCs are not performing at all better than if you could or buy a chunk of shares on the index. So that to me, like, okay, why is nobody changing this? And that led to me to show, okay, we need to flip the model. We need to be transparent, show the progress in real time, and based on that, invite investors to invest in startups.
That's very interesting. And can you tell us now how you're trying to solve all of these flaws at Venturerock?
When I was trying to tell this to my peers from founders' perspective, but also from the venture capital industry, everybody was looking at me like, Marc, this is not possible. And then I said, like, well, that depends on. I think it's possible. And to be honest, if everybody says it's impossible, then yeah, I start some sort of smiling and said, okay, let me show that it's possible. So with Venturerock, we wanted to show the progress of a company from idea stage to scale, because the biggest, of course, failures are made between ideation and Series A plus. So if we can sort of handle that one, then we can prevent a lot of mistakes. But also, and second, in the start, there are no really hard metrics. There are more soft metrics like collaboration, but also execution, speed of execution. And of course, once you grow, then the numbers are more measurable. So hence the reasoning behind, okay, let's build a system where you can measure soft metrics in the start and hard metrics later on. And that's what we've built. And we've built now 12 companies and tested the model. And of course, we are now building it from an MVP in a more technology platform, but that's where we are right now. We needed to just test the product, eat our own dog food ourselves at first.
Absolutely. Is Venturerock a venture capital firm? Is it a startup studio or is it an accelerator? What do you call it?
I don't call it either of them, but
Okay.
or all inclusive. We
Okay.
call ourselves an all inclusive venture capital platform.
Okay.
So that means that we can facilitate companies from ideation to growth, but we
Yep.
can also facilitate other investors to invest in those type of companies.
Awesome, awesome. And I
Yeah.
would like to understand in detail what is this entire system that you have built. It's called Venture Building OS, uh, that your companies follow at Venturerock. So
Yeah.
I would like to understand what goes on in that 72-step process.
So I always compare it to a car wash for companies, right? Every time we go with a car through a car wash, yeah, it's a different process. Car is different, but at the end, the car always seems to come out quite clean. Some of them less than others, but that's not a discussion. The more I've been an entrepreneur myself, but also invested in hundreds of companies, you see that many mistakes are made in the same process, right? And 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 also a lot of things are reinvented. So, for instance, financial planning or admin system or growth systems, everything is redone all over again. So that came up. That's why we came up with a Venturerock operating system, where a lot of things are being some sort of standardized to let the founders focus on what they need to focus on, and that is finding a product market fit and getting the first customers, and not all kinds of other bullshit, shareholders agreement, setting up admin, finding the best tools that work, etc., etc. No, focus on what they need to focus on,
Yeah.
and that's why we came up with the 72 steps Venturerock operating system.
Okay, okay, that's very interesting. So, if you could tell in more detail, how does this actually work in practice? Let's say a founder comes to you. So, what are the initial terms you're going to offer? Are there going to be conditions that okay, if you achieve this target, you're going to get more of this funding? So, are you investing in phases and stuff like that? So, tell us more about that.
Yeah. So we ideally invest in pre-seed, so ideation and maybe the first MVP type of companies. We put them in the operating system at step zero, and step zero for us is a team of minimum two, maximum three co-founders with complementary soft skills and hard skills. So we do already some sort of an assessment on what the fit is of the founders amongst each other, but most importantly, the founder problem fit. If they are really, really, really genuine in love of the problem that they want to solve. Then they enter our 72-step process. We invest 50,000 euros in a safe. They need to go through the first 19 steps, and if they are able to get the first validation, then after step 19 they receive 150k, also in a safe. Based on the next steps, it's all about lean startup, first version of a product, etc., etc. Get the first customers in. We invest in the third phase 500,000 euros, where we can build a more rigorous type of MVP and get more customers paying and feedback of the product. And then if they've been able to show growth in a stable way, when we invest in the fourth phase, 1.5 million, and that will mostly be done in an equity round that triggers conversion of the first three rounds.
Got it. That's a very interesting model. And can you tell us how this model is maybe safer for investing for the VCs? And does this guarantee more returns because you are, spreading out your bets? You're not placing a big bet at once, but like spreading it out. So, would love your view on how that this impacts the return of the fund.
Our unique approach is also that when we start with step zero, together with the founders, we create a vesting agreement. So that means that if somebody is leaving within a certain amount of time, he or she loses all the shares. And we can even replace the founders. So the company is not of the founders, the company is of all of us. So we really have an obligation towards each other, us included, but the founders as well, to build a solution for the problem that we are all in love with. And if that means that somebody leaves, then we can replace the founder. And in many cases, in the former models, company was bust.
Yeah,
And in our case, company will continue.
that's pretty awesome. But are founders welcoming of that? Are they okay? Because this is a significantly different model than almost all of the entire rest of the industry, right? They're following a
Yeah.
different model, and you're doing a different model. So does that mean that you are the only source of investment for them if you're working with them? Uh,
So yes, so that means that if they are able to go through the steps and to the motions
right,
of the entire
right,
car wash,
right.
they receive money from us
Only.
only. Yeah,
Okay,
so they can really focus
okay.
on execution. So that's also attracting most of the startups that we attract. They are experienced founders because they know how hard it is to fundraise, and now they can finally focus on the execution instead of losing valuable time on fundraising.
That's pretty awesome. And I would like a view into how much of equity are you taking in different rounds. Let's say at step zero, what's the equity that you're taking in? Then the next step, maybe step 19. At that step, how much equity more do you take in for the investment you put in? Can you tell us more about that?
So that's undecided because at the end, every valuation of any company in the first 3 years is based on bullshit. So that's why we use in the first three phases only a safe, and only in the last phase together we determine the valuation, what triggers all of our investments, but also of course the time investments and the of all parties involved. So
Awesome,
we
awesome.
determine a
Yeah.
cap table that's healthy
Okay.
of the for the company to do follow-on raise in Series A plus.
Okay, okay, got it. So, is Venturerock investing its own money, or does it have its own LPs? How's it structured, basically?
So we do that currently from our own balance sheet,
Okay,
but we are now in the making of some sort of a dual entity model. So we create a fund that will probably pick up the phase D investments. So we build phase A, B in the first three phases, and the
okay,
fund will pick up the last phase
okay.
because
So,
it's very, it has been very cumbersome to explain a new model like this to
right,
larger LPs. They
right,
were looking at at us like. Currently, we have 45 co-investors in our on our cap table, but they all are entrepreneurs like me. But if we want to attract larger LPs, they look like at us like an odd duck. And yeah, we both know that in the financial world, odd ducks are not really welcome. So now we've created a dual entity structure where we have a fund attached to us, a classic GPLP structure.
absolutely. That's pretty amazing. So, right now, if I say it like that, it's more of a startup than a VC firm because you have your own investors who are on your cap table, and you're investing out of the balance sheet, much like how a startup does, but you're in plans to also get a VC fund in. But for founders, of course, it doesn't matter. They're getting the funding. So they can call you a VC as well because you're funding them and helping them succeed. So that's great.
Yeah.
Uh, that's pretty awesome. And I have learned that Venturerock has 4 offices in 4 different continents, right? That's very interesting to learn. So, would like to learn about how difficult was it expanding to all these different regions, and how do you look at all these different regions, and which one is most exciting to you going forward?
So we believe in a vertical approach. So every entity that we created, they are solving certain problems within a certain industry, gathering co-investors from that industry that are also connected to that industry, so that you really get a knowledge base which you can use from a startup founder perspective. So that means that in Amsterdam we've created a fintech. Um, it's a connection with fintech, but it's more that we build software to create full transparency in the value chain. And that's applicable, of course, to startup finance, but also to supply chains. The second one is a sports stack in Los Angeles, because Los Angeles is the capital of sports in the US, so it makes sense to start one over there. Then the third one was in Singapore, where we are launching some sort of impact builder. And recently we've set up an office in the UAE, where we are going to help urban builders, so technology that creates a better environment in cities. And therefore, we see the specific problems that we want to solve in those specific region as a match. Urban technology with all the things going on in Dubai, Abu Dhabi, but also, of course, the recent announcement of NEOM in Saudi Arabia. It's a huge opportunity for urban tech.
Right, absolutely. That's a very interesting model, like having different focuses for different regions. So,
Yeah,
is it only open for the founders of those particular regions, or let's say a founder in the US wants to solve a problem that's not the focus of the US office, but is focus of the Abu Dhabi office? So, are they going to
yeah.
move there, and then work, or how's it
Yeah.
going to work, or are you going to reject them?
No. So sort of, we also hope that we can attract foreign founders towards the specific verticals,
Okay,
because we also want to collaborate with local parties that have direct access to pilot customers, because that's where a lot of startups have lack of. Nobody wants to be the first customers. So no, we hope we can also attract foreign founders towards that region.
awesome, awesome. But the focus remains the same. The focus of
Yeah,
each region remains the same. The founders can move around, right?
yeah, yeah,
Okay, okay,
exactly.
great. And you have also an amazing experience of being a founder yourself, building a company 12 times, even failing 4 times, having one public listed company. So, can you share what would be your biggest advice for founders that are building now?
Create a support system from day one. And the support system can be future customers, can be experts that can really help you connecting the right dots, and early investors that are also in love or connected with the problem that you want to solve. The earlier you start with that,
All right.
it keeps you more sane along the very difficult ride of starting a business. But you also give the people some sort of co-creation, right? Together, because yeah, you can't do it alone. It's very simple.
Yeah, totally agree. And another subject that's kind of related to this one, that having a support system is really important, especially in a difficult journey like this one. Uh, do you think solopreneurship, as it is being promoted in places, do you think that's a good thing? That's a pathway that founders can explore?
There are
Or,
multiple companies that being started by a solo entrepreneur,
yeah,
as long if you have a good support system.
right.
And then you create a support system that suits you as a person. But yeah, it's I always make a joke. Yeah, if you celebrate successes or failures, it's much cozier to do that with two person than sitting on your own at the bar crying with a glass of beer.
Absolutely, totally agree. But I think at VentureRock, you have a thesis that you're not going to take a solo founder. Is that correct?
We have taken up solo founders, but we
Okay.
always have pushed hard to find a second one
Okay.
because we know that you go much faster when you have two people dedicated on working on a company
Right. Awesome. Awesome.
by far.
And now moving on to my last main question before we do the rapid fire round. And this one is about you've talked about this on other podcasts as well. And this is about having customers as your investors or co-owners, basically. So can you tell us more about this concept?
So I believe in the future of fractional ownership. And that means that it needs to be really easy to invest in a company. Within our ecosystem, we are building companies that makes it possible to invest on evidence in a company with 3 clicks, click, 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 and you are an investor. And and when you looked at it from a consumer-driven, business to consumer-driven companies, I think it's one of the most powerful tools to have a plethora on small investors on your cap table that are all in love of the problem that you want to solve. But there's a big but.
Right.
Don't make the mistake to get them in too early. And we've seen many startups in the early phase doing crowdfunding, and they needed to do a pivot. And what happens that you have a crowd that is investing in proposition, your first proposition, and then you pivot it, and then people say like, huh? Why? I've invested in this. Now you're going to do this. So don't start too early. But once you have determined product market fit, one of the best parts of fundraising is done by the potential customers or already existing customers after product market fit.
Yep, absolutely, totally agree. And that's great perspective on crowdfunding. Like a lot of founders consider it initially, if they're not able to raise from institutional investors, they go the crowdfunding way, raise some money. But there can potentially be a case that in future we'll need to pivot, and that'll be really hard to communicate that
Yeah,
to a
yeah,
crowd than a
yeah.
single or two, three
Yeah.
investors, right?
And then
Uh,
even
yep,
I've seen and experienced pushbacks of the crowd, like what the hell? Yeah, it's sort of, I've invested in this, and why are you pivoting? Yeah, and
right,
that's
right.
then you can have a negative crowd, and then it will be really difficult to succeed.
Absolutely, that's very helpful there. And now let's do the rapid fire round here, and I'll ask you five quick questions about the investing that you're doing, and you have to give five quick answers. Sounds good. All right. So the first one goes: what are the sectors and regions you invest in?
Europe, MEA, and Asia, APAC mainly, in fintech, urban tech, and sports tech, and all with a problem that is worth solving. So we have always an impact angle.
That's great. And what's the typical stage of investment?
Pre-seed as early as possible.
Awesome. And what's the typical check size you put in?
We always start with 50K,
Great. And how much can this potentially increase over time?
2.2 million,
Over the course of until Series A, I guess, right?
3 years.
Awesome.
Mainly, most of them 3 years.
Great, great, great. And where can founders apply for funding in case there is a direct way?
We don't have a direct way. It's most of the companies are some sort of referred to us because we can't handle thousands of applications. So we build 3 or 4 companies per vertical together with the founders. So
Yeah, that's great. Where can our listeners go and follow you to learn more?
I'm very active on LinkedIn. So please follow me on LinkedIn, and then they will also keep informed about our progress and what we do.
Awesome, Mark. It was great having you on the podcast, and it's always great. Personally, I feel great whenever there is a new innovation or a new model that comes up in investing, because even the venture capitalists love innovation when it comes to investing in startups, but are themselves not very innovative. But I love
No,
what you're doing here,
thank you.
and all the best to you, and happy investing.
Thank you.